Quick question before we start. Imagine the markets completely froze. If markets stopped printing prices for 10 years and a recession hit in year 2, would you still feel calm owning the bonds in your portfolio?
Because if you wouldn't, the bond isn't doing the job you hired it to do.
Exactly. Welcome to Capital Allocation Lab, an audio-first library of classic investing ideas, re-explained for today's long-term, fundamentals-minded investor.
We focus on judgment, how to think, how to stress test, and maybe most importantly, how to avoid the expensive mistakes that only show up when the cycle turns.
If you find this useful, please subscribe and like to support more educational episodes. It's the simplest way to keep this channel growing.
And please tell us in the comments what concept you want us to tackle next. It could be margin of safety, owner's earnings, ROIC versus ROE, dividends versus buybacks. We really do build the queue from your questions.
One more note. This is educational content only. We are not providing any individualized investment, legal, tax, or accounting advice.
All right, so today we're diving into Chapter 7 of Security Analysis, and the topic is bond selection. Specifically, we're looking at two principles that can feel a little old-fashioned until you live through a real credit cycle.
And we're focusing on two very specific principles today. First, Principle 2 from the book. Bonds should be bought on a depression basis.
And Principle 3, it is unsound to sacrifice safety for yield.
Those two ideas right there. They are really the antidote to the two most common mistakes you see with bonds. First, buying a supposedly safe bond just because the business feels stable.
And second, reaching for yield because you're frustrated with low coupons and you just want a little more income.
So our goal today is to make these ideas concrete, practical, and, modern without losing any of the discipline from that original argument.
Definitely. Let's make it useful.
Okay, so before we really unpack this phrase depression basis, which, it sounds pretty intense, I think we need to clarify the actual function of a fixed value investment. What is a bond meant to do in a portfolio?
Yeah, that's the perfect place to start. It's so important to strip it down to the basics. At its core, a straight bond is a contract. That's it.
A contract.
You lend money. You get scheduled interest payments. And you expect your principal back at maturity. It's a promise.
And that expectation, getting your money back, that's really the whole point, isn't it? It implies that the return of your capital is the non-negotiable part of the deal.
100%. The return on your capital is secondary. A bond isn't supposed to be a thrill ride. If you want thrills, buy a ticket to the movies.
I love that analogy. If you want entertainment, go to the cinema. Don't look at your bond portfolio for that dopamine hit.
Right. With fixed value investments, you're buying stability of outcome, not excitement. You're buying predictability.
But the reality is that's not how they're sold. Bonds often get marketed in a way that encourages the exact wrong mindset.
Oh, absolutely. The marketing encourages people to shop for them like they're shopping for rental income on a property. They ask, how much monthly income can I squeeze out of this thing?
And Chapter 7 is basically Graham and Dodge shouting from the rooftops, stop doing that. Start with safety. The income you get is a consequence of that safety, not the other way around.
So here's a good way to frame it. When you buy a bond, your primary goal is to avoid permanent impairment of your principal.
Getting your money back.
Yes. Your secondary goal is to receive a fair return for the risk that you did accept. Notice the order there. Safety first.
That mindset naturally leads you to stress testing, doesn't it? Because the only time you truly discover whether a bond is safe is when conditions are decidedly not safe.
Exactly. Which brings us to this phrase that's going to come up a lot today, the acid test of depression.
Okay, so let's clarify that. When they say depression, are they telling us we all need to become macro forecasters and, predict the next 1929?
No, and that is a crucial distinction. They're not saying you must predict depressions, not at all. They're saying you must structure your decisions so that if a severe downturn arrives, whenever it arrives, you're not forced into a bad outcome.
So it's the difference between forecasting and preparedness.
Yes. You don't know when the hurricane is coming, but you build the house to withstand it. Regardless, we're not forecasters here. We're builders. We're trying to build resilient decisions.
Okay, I like that framing. So let's dive into Principle 2. Bonds should be bought on a depression basis. Let's translate that into plain English for today.
It just means you don't judge a bond by how it performs when everything is going right. Any bond looks fine when corporate profits are booming and credit is loose and cheap.
Of course. It's easy to look good in a bull market.
The real test is judging it by whether the issuer can keep paying its interest and frankly survive when earnings fall, capital markets tighten up, and refinancing suddenly becomes very difficult.
And Graham and Dodd say investors often feel safe for one of two reasons, and they get this wrong. Reason one is this industry is stable. It's basically depression-proof.
And reason two is, even if earnings fall, this specific company has such a big cushion that the bond is protected.
And their whole point is you should be focused on the second reason. Because the first one, that depression-proof industry idea, is a trap.
A huge trap.
Let's unpack that trap carefully because I think a lot of people fall for this. It just feels so intuitive.
The intuition goes exactly like this. Utilities sell electricity. People always need electricity, even in a recession. Therefore, utility bonds are safe.
Or this company sells consumer staples. People still buy groceries and toothpaste when they lose their jobs, so these bonds have to be safe.
But the problem isn't that the business is stable. The stability of the business is great, but it's not the whole story. The problem is the financing structure on top of that business.
A stable business can still be a very dangerous bond investment if it's, and I love this phrase from the book, bonded to the limit of its prosperity earnings.
That phrase is so important. Bonded to the limit. It means the company has piled on so much debt that its fixed charges, its interest payments, consume almost all of its good times earnings. There's just no breathing room.
Which means even a modest decline in business can be fatal to the bondholders.
Let's do a tiny example with really round numbers. Let's say a company earns 100 in operating profit, and it has interest expense of 80.
Okay, so let's do the math there. The interest coverage is 100 divided by 80, which is 1.25 times.
Right, 1.25x. And in good times, it pays its bills. It looks fine on a screen. But now a mild recession hits, and its operating profit falls by just 20%. So it goes from 100 down to 80.
Now the coverage is 80 divided by 80. That's exactly 1.0 times. There is zero margin of safety left.
Zero. And any little hiccup, the sudden need for working capital, some unexpected maintenance spending, a big customer paying late, and you miss a payment. The contract is broken.
And if the decline is a little worse, say 30%, then operating profit becomes 70. Coverage is now 70 divided by 80, which is 0.875 times. You're officially short. You can't pay.
And notice what happened there. The business didn't collapse. It didn't go to zero. It just got a little worse, which happens. But the capital structure, the debt load, turned a little worse for the business into a full-blown crisis for the creditors.
That's why the chapter insists on this. Once you admit that any industry can suffer some reduction in profits, you're forced into the same exercise everywhere, regardless of the industry.
You have to estimate the possible shrinkage in earnings and then compare it to the surplus the company has over its fixed charges.
Which is just a fancy 1930s way of saying you have to stress test the coverage ratio.
Precisely. And this is where the book makes another really subtle but important distinction. It's not that some industries are immune and others are cyclical. It's that all industries vary by their degree of fluctuation.
Right. So the more stable the business, the more debt it can probably carry safely. The more unstable or cyclical it is, the more margin of safety you need in the capital structure, which usually just means less debt relative to the total capital.
That's a capital allocation lesson for managers, as much as it is a bond selection lesson for investors.
Because for a management team, debt is a tool. But for you, the investor, that same debt is a claim that can become a choke collar if earnings wobble even a little bit.
Another key point they make here is the difference between quantitative and qualitative tests. We hear these terms thrown around all the time, but let's define them in this specific context.
Quantitative tests, those are the ratios, the hard numbers. Things like interest coverage, leverage, liquidity ratios, asset coverage.
The spreadsheet stuff. And the qualitative tests are about the nature of the business itself, its competitive position, its durability, the quality of management.
And the big disconnect they highlight is that a bond can pass all the math tests based on its past performance, but it can still fail the real-world test because the underlying business model just isn't resilient.
This is such a critical modern lesson. Historical ratios are not a force field. Looking at backward-looking coverage from a great decade doesn't prove anything about forward safety, especially if the last 10 years were unusually favorable.
That is such a critical point. You look at the spreadsheet and the numbers from 2015 to 2021 look amazing, and it says safe. But the world might be changing underneath that company's feet right now.
Which is why Graham and Dodd classified enterprises by their inherent stability. They had railroads, public utilities, and industrials.
The logic was pretty simple, right? The more stable the earnings seemed, the smaller the cushion of safety they would accept. The less stable the business, the larger the cushion they demanded.
It's like the analogy of lending to a household. You use different standards for someone with a stable government salary versus someone who earns entirely on sales commissions.
Of course, that's just common sense.
Okay, let's talk about their laboratory. I mean, the historical stress tests they used to prove their point.
They looked at two distinct periods of stress. The first was 1931 to 1933, which they called the laboratory test. That was just catastrophic stress.
Total meltdown.
Mm.
And then they looked at 1937 to 1938, which was a very painful recession, something you might see more commonly.
Let's get into the data points, and I want to make sure we read these numbers exactly as they are in the source material.
Okay, look at the railroads. In the late 1920s versus 1932, their operating revenues were in the mid-6 billions in the late 20s. By 1932, that was cut in half.
Cut in half, and the net railway operating income. That went from $1.2 billion down to just a few hundred million.
That is just massive operating leverage working against you. Revenue drops by 50%, but income drops by 80% or more. It's brutal.
And what was the market reaction to this, the prices of the bonds?
The yields on high-grade railroad bonds, which were considered very safe, went from the low fives, 5.25%, up to over 7% at the peak of the stress. Prices collapsed.
And this brings up a concept you call dual suffering. Bonds actually suffer in two ways during a crisis like this.
That's right. The first way is fundamental. The company's actual ability to pay you back gets worse. That's the obvious one.
But the second way is the market. Yields on everything rise, so the price of your bond falls, even if it's still paying. And liquidity just evaporates. You can't sell it for a fair price if you need to.
So even if you're determined to hold to maturity, those huge price moves test your patience, they test your resolve, and they can trigger institutional risk limits that force you to sell at the worst possible time.
Okay, let's look at the lessons from a few specific sectors they analyzed. Let's start with utilities. What was the cause of failure there?
It's so interesting. The defaults were almost never caused by the earnings completely disappearing. People were still using electricity.
So what was it?
It was capital structures that were just too tight. They were overextended on debt.
And specifically, they used these things called pyramided structures, right?
Yes, with layers and layers of holding companies. So the cash from the actual operating utility had to flow up, and it got sliced and diced by fixed charges at every single layer before it reached the bondholders at the top.
It looks like brilliant financial engineering in the good times.
And it becomes a catastrophic cascade of defaults in the bad times. The whole thing implodes from the top down.
So the lesson here is you can't outsource your thinking to the industry label. You can't just say, it's a utility, it's safe.
No. And their quote on this is so powerful. Ordinary prudence in selection could have avoided most of the losses. In other words, the warning signs were there if you looked.
So the modern application is that even a business with stable cash flow is not a safe credit if its debt load is too high or if its maturity schedule is too tight.
Exactly. Now, what about the railroads? The big misconception there was that investors just assumed the earnings were incredibly stable, which led them to accept insufficient margins of protection.
And it wasn't that they were being completely reckless. They weren't just abandoning all standards. They were applying old standards to an environment that was fundamentally changing.
And the warning there is so timeless. Standards go stale. If the economics of an industry are changing, the rise of trucking and automobiles in their case, then the required cushions of safety must also change.
So you have to cultivate this forward-looking habit. You have to watch for businesses that just aren't keeping pace with the broader growth of the economy.
And they mention a specific rule of thumb, the twice-over rule. They said if investors had just applied the standards they use for industrial companies, which meant demanding higher coverage to the railroads, they would have avoided most of the losses.
So as a rule of thumb, twice over, meaning earnings cover interest 2 times, should be seen as a bare minimum. And for more cyclical issuers, you should demand even more.
But there's a big caveat here. Numbers alone don't rescue a weak or deteriorating business model. A high coverage ratio on a dying business is not safety.
Right. Which brings us to the industrials. The risk here was unique. What was it?
With industrials, the earnings can literally vanish. They can go to zero or negative.
So it's not just about the size of the cushion. It's about whether the entire business even survives the downturn at all.
The nightmare scenario is this. Your bond contract is perfectly intact.
Right.
You have a legal claim, but the enterprise itself produces no cash to pay you with. The promise is worthless.
So what was their recommendation for industrial bonds?
They said if you're buying straight industrial bonds, you must restrict yourself to companies of dominant size and substantial margins of safety.
Using size as a proxy for resilience, right?
Yeah.
The idea being that a huge company has more diversified demand, better access to capital markets, more levers to pull.
Exactly. But this creates a problem, the scarcity warning. If you apply these strict standards, you won't find many bonds that qualify.
And their key quote on this is just fantastic. The unavailability of sound bonds is no excuse for buying poor
You
ones.
can't just lower your standards because you need the income. If a bond is actually risky, you should demand a price discount or some kind of upside, not just a slightly higher coupon. Don't blur the categories.
Okay, this is all great theory. Let's try to build a modern checklist for buying on a depression basis. I think we can boil it down to 3 main tests. Test number 1 would be the earnings test.
Right. And the question you ask is, can this company cover its interest payments and all of its essential spending during a severe decline?
And essential spending isn't just interest. It's maintenance capital expenditures. It's working capital needs.
The stuff it has to spend to stay in business. And comfortable coverage means you have a big buffer for the fact that your forecast is probably wrong.
Okay, test number 2, the liquidity test.
This is critical. Even if earnings fall, does the company have enough cash on hand or capacity on its revolving credit line to avoid a forced refinancing at the worst possible time?
Because you can be solvent but illiquid. And solvent but illiquid still equals failure for a bondholder.
It absolutely does. And test number 3, the structure test.
Where does the debt actually sit in the company? Is it at the operating company level, close to the assets, or is it at a holding company?
And are there other lenders ahead of you in line? Are there secured lenders or big pension liabilities that have a prior claim on the assets? Who gets paid before you do?
I think those 3 tests cover it. Let's walk through a detailed stress test example with the math. And again, I want us to read these numbers exactly.
Okay, let's imagine a mature company. In a normal year, its EBITDA is 1,000, it has maintenance capex of 200, and cash interest expense of 250.
Okay, so the normal calculation. You take EBITDA of 1,000, you subtract the maintenance capex of 200, and that gives you 800. That's your pre-tax free cash flow available to service debt.
Correct. And the cushion is that 800 minus the interest of 250, which gives you a cushion of 550. Looks very safe.
Plenty of room.
Mm-hmm.
No, let's do the downturn calculation. Let's say a recession hits and EBITDA falls 30%, so it goes down to 700.
Maintenance capex. Let's assume it stays at 200. You can't really cut that. So your post-maintenance cash flow is now 700 minus 200, which is 500.
And the cushion. You take that 500, subtract the 250 of interest, and your cushion has shrunk from 550 all the way down to 250.
It's been cut by more than half. But wait, there's more. We have to consider the working capital hit. In a downturn, sometimes you need to invest more in working capital as receivables stretch out.
Right. So let's assume this company needs an extra 150 for working capital during the downturn.
Your final cushion is now that 250 minus the 150 for working capital. You're left with a final cushion of just 100.
Wow. So the conclusion is it still pays, but it is incredibly tight. Any other unexpected issue, a lawsuit, a regulatory change, and you're in real trouble.
And that's the discipline. You have to ask, how does this behave under stress? Long before you ever ask, what is the yield?
This leads us to the proper theory of bond financing. We need to debunk a couple of common myths.
Let's do it. Myth number 1, debt is always bad. And myth number 2, if you can't issue stock, you should issue bonds.
So what's the reality?
The reality is that debt is a perfectly sensible tool for a prosperous business, if it's kept within limits that can be handled under all conceivable conditions, not just good ones.
So there's a mutual benefit. The business earns more on the capital than the cost of the debt, and the investor gets a safe, predictable return.
And this gives you a great screening rule. Healthy borrowers borrow opportunistically when the terms are good. Unhealthy borrowers borrow out of compulsion because they have to. You want to lend to the former.
Okay, let's pivot to principle 3 now, the yield trap.
This one's so important. The principle is, it is unsound to sacrifice safety for yield.
This gets at what you call the insurance premium fallacy. Explain that.
So the mental model a lot of people have is that the extra yield you get on a risky bond is like an actuarial premium in insurance. It's a mathematically precise compensation for a predictable risk.
But that's not the reality, is it?
Not even close. The reality is that bond prices are driven by popularity, marketability, and sentiment, not by precise math.
And there's this problem of risk instability.
Right. Unlike stable mortality tables and life insurance, investment risks cluster together. They're like epidemics or conflagrations. Everything goes wrong at once.
So your diversification fails you. All your risky credits weaken together in a crunch because they're all correlated to the same economic stress.
And the typical investor experience is this. You spend years collecting a little bit of extra income, which you probably spend, and then that's followed by a sudden deluge of principal losses that wipes out all the extra income and then some.
So the rule from the book is that income return and principal risk are incommensurable. They can't be measured on the same scale.
Right. And the prescription is brilliant. They say if you're going to accept real risk of principal loss, you should demand principal enhancement in return.
Meaning what?
Meaning you should be buying the bond at a big discount to its face value. Or it should have some kind of conversion feature that lets you participate in the upside if things go well. You shouldn't just be getting a higher coupon.
The psychology of that is so interesting. A discounted bond forces you to acknowledge the risk you're taking. A par bond with a high coupon just seduces you into thinking you're getting free money.
Perfectly said. It feels like income, but it's really a return of your own capital waiting to be taken away.
Then there's the business person's investment fallacy. What's that?
This is the bond that's marketed as, mostly safe, but with a higher yield for sophisticated investors who can handle a little risk.
And what's the logic flaw there?
The flaw is, if you're in a position to take real risk, you should be seeking real equity-like upside. A high-coupon, low-quality bond offers you all the equity-like risk, the potential loss of your entire principal, without any of the equity-like participation in the upside.
So it's the worst of both worlds.
It's the absolute worst of both worlds. You have a capped upside and an uncapped downside.
Which means we need to be reversing the customary procedure for selecting bonds.
Yes. Let's talk about the common mistake first. The customary procedure is you start by looking at really safe bonds, like government bonds. You see the yields are too low for your needs, so you start sliding down the quality ladder until you find a yield that feels acceptable.
It's like shopping for a parachute and deciding to cut a few corners on safety features to save some money. It's insane when you think about it that way.
It is. So the correct method is to completely reverse that. You set your minimum standards of safety first.
And anything that fails those tests, you just disqualify immediately, regardless of what yield it's offering.
Exactly. Then, from the small pool of bonds that actually qualify, you choose among them based on yield or other preferences.
The benefit of that process is that it prevents that slow, dangerous drift into unsafe territory. You build a wall and you don't go past it.
It's a non-negotiable floor of quality.
So how do we actually go about building those minimum safety standards? What would they look like?
I think we can lay out 5 key standards based on everything we've discussed. Standard number 1 is qualitative.
Okay, what does that mean?
The business must be one that is likely to survive a prolonged downturn without permanently destroying its earning power. Does it have a durable reason to exist?
Okay. Standard 2, coverage.
The company must show robust interest coverage, but calculated based on its potential depressed earnings, not its best year earnings.
Standard 3, maturity.
You need to see a manageable refinancing risk. There shouldn't be a giant cliff where all the debt comes due at once, especially not in the middle of a potential recession.
Standard 4.
Structure. No pyramided or overly complex structures that starve the specific bond you own of cash flow. You want to be as close to the real assets as possible.
And finally, Standard 5, management.
You want to see a management team with a history of a conservative financial policy. You're looking for a track record of resilience, not a history of aggressive, debt-fueled issuance.
Those 5 standards have massive portfolio construction implications.
They really do. It forces you to be clear about the role of bonds in your portfolio. They are ballast. They are there to keep the ship upright in a storm. They are not there to make it go faster.
So you really end up with 2 buckets in your portfolio.
That's a great way to think about it. First, you have your sleep well bucket. This is where your high-quality, resilient bonds go. Their job is preservation of capital and preservation of your optionality to buy other things when they get cheap.
And then you have your return-seeking bucket.
Right. This is for your equities, your opportunistic credit investments bought at a discount, special situations. Here, the risk is known, it's embraced, and it's sized appropriately.
And the big failure mode is mixing those 2 buckets. It's treating a return-seeking asset as safe, just because it happens to pay a steady income.
That's the trap. And the key is you have to decide on your rules and which bucket things belong in before the stress arrives. You can't make these decisions in a panic.
Okay, let's finish up with a really practical tool. Let's call it the 10-minute bond interview, a set of questions you should be able to answer before buying any bond.
I love this idea.
Okay, question 1. What is the business and what problem does it solve? Is it durable?
Question 2. What does the weakest plausible year for this company look like? And what happens to the interest coverage in that year?
Question 3. What is the essential spending? The maintenance capex, the working capital that absolutely cannot be cut, even in that bad year.
Question 4. Where are the maturities? When does the debt come due? Is there a big wall of it?
Question 5. Is my bond at the operating company or a holding company? Am I close to the cash or far away?
Question 6. Who is ahead of me in line? Who are the secured lenders? Who gets paid before I do if things go wrong?
And question 7. How has this management team behaved with leverage historically? Are they prudent or are they gamblers?
And here's the verdict. If you can't answer those questions with confidence, you are not buying that bond on a depression basis. You're speculating.
And the permission to do nothing, to just pass on an idea you don't understand, is probably one of the most underrated skills in all of investing.
Absolutely. If you can't answer the interview questions, the answer is no.
Let's do a quick closing synthesis. Let's recap the 2 big ideas. Principle 2.
Buy as if a downturn is coming. Judge a bond by its ability to perform under stress, not by its good times financials.
And principle 3.
Don't trade safety for yield. The principal losses, when they arrive, tend to arrive in clusters and will wipe out years of extra income.
And the big process takeaway for me is to set your minimum standards of safety first. That's what protects you from being slowly pulled down the quality ladder by the siren song of a higher yield.
And it protects the core job of bonds in your portfolio, which is to provide stability and optionality when you need them most.
Well said.
Thanks for joining us on Capital Allocation Lab.
Our mission is to teach disciplined, long-term investing by revisiting these classic ideas, but without the hype and noise of the daily market.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And please, leave a comment with your thoughts. We'd love to hear your ideas on bonds versus cash or any other stress testing concepts you use.
See you next time.